A very good afternoon, ladies and gentlemen. Thank you for joining us in today's session of Uncovering Trading Strategies with professional trader Ang Kar Yong. So for those of you who have joined us for the very first time, welcome. We hope today's session will be beneficial for you. For those of you who have returned, welcome back again. So just to share a very quick, just very briefly sharing with you some of the perks of our platform Phillip MetaTrader 5 that will be the platform that Kar Yong will be using in these sessions, right? Some benefits of it to share with you. So if you do not already know, Phillip Nova offers Phillip MetaTrader 5, and currently on this platform we have over 650 contracts, right? One of the most comprehensive one available in Singapore. So we have a range of Forex, precious metals, and CFDs, including global indices, equities, commodities, and even cryptocurrencies, right? So the great thing about this platform is that it is fully zero commission, right? So what you see is what you get. The trading, the cost of trading is within the spreads that you see on the platform. So this includes a share CFD as well. So there is no minimum fee that you need to pay. So on top of that, we offer extremely competitive spreads, right? So our majors, for example, euro dollar starts from 0.6 pips, and that is on a zero commission basis. So to make this even more competitive, right, we know the need for having smaller sizes for people who are starting out or just with a smaller balance, right? So we do offer micro sizes for global indices. The 3 US global indices are available in micro sizes. So for our equities coverage, we have US, Hong Kong, German, and Singapore, right? And the great thing is that this begins from one share only. So if you were to trade the traditional equities, cash equities, you'll notice that this might be available in larger sizes. But for our Hong Kong and Singapore shares, selected ones, they do start from one share only. So this allows you to begin with a smaller equity size. So we are the first MT5 to integrate with Acuity Signal Center. So if you are interested, do scan the QR code at the bottom. What you will get is a free 30 days risk-free demo, preloaded with 100,000 of virtual credits for you to try, trade the contracts we have available, and just give the mechanics a test drive, right? So on top of that, it comes with key information as well from FX Street, Trading Central. These are primarily for fundamental traders who looks to up-to-date news and economic data releases. These are all available within one platform itself. And not to mention, we do have a strong support team available, 24/5. So it covers all trading sessions, so you have nothing to worry about. So let me move on quickly to share with you about our speaker today. So our speaker today is Kar Yong. For those of you who have been attending our sessions, he is no stranger. But quick background, Kar Yong is a veteran within the space. He started trading since he was only 21, and he turned 500 USD to $13,000. So in terms of ROI, that's a huge return. And he done that in a span of 2 years. So due to this success, he was featured in multiple channels, right, such as Singapore Channel News Asia Money Mind. He was awarded the most popular FX trainer in APAC, top Forex analyst in Asia, and most recently, best digital marketing trader by Trading Live. So he has gone through the ups, the downs, the different stages in terms of trading. He understands the struggles that people face, and also the pitfalls that traders face at the starting of their journey. So I believe he's the best person to be sharing today's topic. And indeed, it is about learning about Elliott Wave. So without further ado, I'll hand this time over to Kar Yong. Kar Yong, over to you.
All right. Okay. Good afternoon, everyone. Okay. So today's session over here is actually a continuation from where we left off from the previous session over there as well, where we talk about Elliott Wave, sharing with you the concepts and principles of how to utilize this principle in your trading and your analysis. So of course, it's important that you have that foundation that we covered in the last two sessions. Okay, so for the benefit of those of you who perhaps just joined in this time round, I'll do a very quick recap in terms of a summarized version of what we have covered in the last two sessions. And then after that, we'll continue to progress on to today's content over here. Now, suppose you miss out and maybe you have attended in the previous two sessions and you would like to have a review, maybe you forgot certain things, or you just like to look back at what we have presented last time. The recordings can be found, if I'm not mistaken, on Phillip Nova YouTube channel as well. Okay, if not, you can always also reach out to them to see if they can send over the recordings to you guys. Okay, so let me jump onto the chart to kind of recap what we've covered in the last two sessions first. Okay, and then we'll jump on to today's content. Okay, now quick one. Okay, last two sessions, what we did was we talked about the foundation of how price tends to move, and I always say that's the most important aspect if today you want to pick up Elliott Wave, is to understand and be able to identify what we call by impulse and correction, and we look at the market in patterns, in combination of impulse and corrections. Okay? So very quick one here, impulse move are basically market movement that are fast. Okay, so it can be coming down very fast like this here, that's impulse. It can be going up very fast, that's also an impulse. Okay, so impulsive move are basically strong momentum, and the opposite is corrective move. So corrective move are usually slow, and it gives off a lot of overlapping nature, right? So if you look at this here, it goes up, it came down, it goes back up, and then now it seems to be coming back down. So this is what we call a corrective phase, right? So this one here, you can see going up, coming down, going up. That's also a corrective phase. Okay. So some charts are very obvious, impulse and correction. Some charts, sometimes you may not be very confident as to what is developing. So I always say focus on the clear ones, right? So this is how to identify impulse and correction. That's very important. And we then start to mix and match. Look at pattern, looks at combination of that. So if you get an impulse move, okay, following that a corrective move. So usually we just draw something like that to illustrate it, right? Impulse, correction. Whenever you see this combination, it's a trend continuation pattern and you expect this to continue to fall, right? There's a high probability that will continue. Now, suppose you see an impulse drop and then after which you don't get a correction, but you get a slanting down move, which is the same direction of impulse. We call this a crawl. Now, this move here is also slow. It's just that it's moving in the same direction of the impulse, right? So we just give it a different description, a different name. We call it crawl. And often you see a crawl, that's a reversal sign. Okay. Let me very quickly show you some examples of a crawl. Now, okay, let me remove everything here. Okay, so this here, perhaps on the hourly, so I'll use S&P, I think that's clearer. Okay, so if you look at this here, just a very quick one so that you get a visual idea of what I mean. Okay, this part here is a crawl. This is obviously an impulse, then it starts to slow down, right? So this is what I meant by impulse combined with a crawl. You often have a high probability the market will actually reverse. Okay, so that's an example just to highlight on that. Now Aussie dollar, okay, has a very nice little example of an impulsive move following that corrective move, right? So this again has a high probability of this coming down. Okay, so just want to very quickly recap on what's impulse, what's correction, how we combine them. Okay, so that's what we covered in the first session. Now the second session we cover is the wave expectation, right? Where we talk about generally we always expect a 3-wave move in the market for most of the time, and if it's a crawl, we expect a 5-wave move. Okay, so in terms of like correction over here, you can see internally, okay, we do have a 3-wave move, right? 1, 2, 3, right? So that's the time expectation. Okay, giving us an idea like, is this almost ready to be focusing on, or do we need to give it a little bit more time? Okay, so that's what we call a 3-wave move. Often we use a 3-wave move to anticipate the time element, the time aspect of the market. Okay, now if we look at a crawl, it's slightly different. That's where we have another expectation. We call it a 5-wave expectation. Okay, so why 5? So if you take a look at this from this low, first impulse 1, 2, 3, 4, 5. Often that's how it's likely gonna develop. Obviously, it's not gonna be all the time like that, but often when you see a crawl, okay, you want to see 5 move internally. We call it 5-wave, or you can see there are 3 touches at the top. Okay, so mathematically, if we have a 5-wave move, we should have 3 touches. Okay, so this is a crawl that's going up, so we're looking at the top. If the crawl is coming down, then we're looking at the bottom. Okay, so that's the 5-wave and the 3-wave expectation that we discussed in detail in the previous session. Okay, so now these two elements, or I would say these two lessons, okay, you can't take them apart and say that, oh, I only use one of it and then we just continue with today. You can't, right? Everything is a build-up. Okay, it's like, you know, building a house. You need to start with the foundation, and then you start to build up the pillars, and then you cover it with a roof. Okay, so whatever we cover today, I want you to know that you don't want to see them in isolation. Okay, you want to look at them as a big picture, and all these pieces all have its own function to fulfill the entire strategy itself. Okay, so today's presentation over here, what we've prepared, okay, is to add another element, another dimension into that by looking at Fibonacci ratios, looking at some of the relationships on wave movement, okay, and how we can then use fibs, for example, retracement as well as expansion, to help us identify some key areas in price point for us to be focusing on, whether is it going to be for entry conditions or is it going to be target. Okay, so first session, impulse and correction, the objective that we want to take up from that is the directional bias, right? To tell us whether to focus on the buy side, the sell side, or, you know, just to be patient, not to be trading. The second session, when we talk about 3-wave expectation, 5-wave expectation, that's the time element, right? It's giving us a little bit of time perspective. Do we want to be focusing now, or, you know, we just want to be patient, give it time to develop and come back another time? So we have the direction, we have the timing element, and today's session over here with fibs is to give us the specific precision on price area. Okay, because you have a direction, you know to buy, you roughly know the time, but you want to then streamline down towards like, so which specific price area should we be looking at? Okay, and that's where the Fibonacci areas can come in, right? So I want to again give you the bird's eye view in understanding what of all these pieces contributing to the entire strategy itself, right? So you have direction, you have time, and today we're going to talk about price points. Right? So very quick over here, what is Fibonacci retracement? I mean, if today you guys are experienced in trading, you may or may not have used the Fibonacci retracement yourself, or perhaps you've come across it before, it's not a very complex concept, okay? But let me just very quickly go through for the benefit of everyone. So what is FIBS? FIBS essentially, I always highlight, is simply put a measuring tool, right? It's just like your ruler. You would like to measure some distance, you have a tool to measure it, and Fibonacci itself is just a measuring tool. Now, some traders call it an indicator. I personally don't categorize that as an indicator because you need to manually decide which point you want to measure, right? So it's not really something that is like indicator, plug and play, and it calculates things for you. This is basically a ruler, so you need to know how to use it to measure, right? From which point to which point. You can't just anyhow pull it, okay? Then it wouldn't be very, very useful. So I want you to know that FIBS itself is like a tool, it's like a ruler, okay? And your role is to understand how to best use it, okay? So we have generally three categories. We have the retracement concepts, okay? We have the extension concept, as well as we have the expansion, okay? So often we use a lot of retracement, and in Fibonacci, in Elliott wave itself, we use a lot of Fibonacci expansion as well. Now, certain platforms may have slightly different names, but I think more importantly is for you to understand the principle behind it and how to use it. Now, what I mean by that is, if today you're using MetaTrader, right, which is developed by MetaQuartz, they use Fibonacci expansion, whereas on TradingView, the name of it is the same tool, but the name of it they put is Fibonacci extension. Okay, so I just want you to be aware. Don't get too stuck onto why the names is different and which one is correct and such. But I think more importantly is understand the principle and then just use the tool. Okay, so retracement over here, some of the common fits that we will be using and we'll be touching a lot would be primarily the 50 and the 618. Okay, now sometimes we use the trade 2 and the 786, but I would say almost 80 to 90% of times when we're using fits to complement Elliott wave, the 50 and the 618 is more of the important ones. Okay, so how do you pull it, right? So this again is important because different traders will use it slightly differently. There's no right or wrong. But if today you want to use it for Elliott wave in particular, that's the guidelines, right? That's the conventional way to pull it, and I'll share with you how, right? So when we're using fit retracement, the idea of it is we're trying to find out after a impulsive move, okay, after a very strong move to a particular direction, we want to measure the pullback, okay, the correction itself, okay, or terms like retracement itself, right? So when you pull this tool, you would always want to pull it in the direction of the move, right? So if the impulse move is to the upside, when you pull this tool, you want to pull it from low to high, right, in the direction of that move. If the market is coming down, okay, so impulsive move from the high to the low point, then when you use this tool, you want to pull from swing high to swing low, okay? So just remember, when you're measuring and you're using fit retracement, you're pulling in the direction of the impulse of the market movement itself. Okay, so this is what I meant, right? If you measure retracement of the up move, we pull from low to high. If you measure the down move, you put it from high to low. Okay, so give you some visual aspect of what I mean. Okay, so if you take a look at this, we have an impulsive move to the upside, right? Very fast move. Okay, that's where the concepts and the principles that we cover in the very first lesson comes in. Okay, because that's the foundation, right? So if this is a very fast move, it's an impulsive move, it tells us the momentum is definitely to the upside. And if you can get a correction pullback, the direction we're focused is going to be upside. Okay, so we of course talk about the three wave just now, right? Very quick recap. So the idea is, again, you want to see and visually be able to identify three wave to give you the timing element. So this one here, obviously we do not have that. We want to be patient, right? So we kind of have a sense of direction, we have a sense of timing, and then fits comes in, right? Third step, to understand, okay, so if I have the direction, if I roughly know the timing, which price point, which price area should I be focusing for a trade? Okay, so for us to then pull fits retracement, this is an up impulse move. we're going to take from low and pull it to the high, right? So we need to follow the direction of it. And of course, the tool will automatically show you this levels. You don't need to go manually calculate it. You just need to know how to pull it. Okay. Now, slight details over here. Some traders will pull it from candle close or candle open prices. Okay. Now, for Elliott wave, we pull it from week to week, right? Which means the lowest and the highest point. Okay. We don't take the candle open and close prices. We take the week to the week, right? Or you call it the shadow. Okay. Now, the reason for that is because in Elliott wave principle, if there's a shadow or there's a week, it basically represents that price has indeed been there before, right? If you go down to the lower time frame, that week, that shadow can be a 1 minute, for example, candle open or candle close, right? So from Elliott wave perspective, the price has indeed traveled to that point, and we often just use it. Okay, so don't overcomplicate it, right? We just basically take from the lowest to the highest if it measuring to the upside, right? So 15 and 618 is over here. And that's where I mentioned, 80 to 90% of time we'll always expect and utilize this area because often that's where the market would go towards. Okay. So if you kind of put things into perspective from here, right? We have an impulse, we expect a correction, which is a slow move pullback. We expect a three-wave move, right? In terms of timing. And then right now we have a precision area. Okay, we have a specific zone in price that we know that would be something that we're interested in. Okay, so I want you to be able to see how things are stacking up, right? From the very, very first lesson all the way until today. Okay. Now, so this one here is not the best example, but I just want to show you how price often likes to do that. And around that 15 and 618, we always get a bounce. Okay. Now, it's not going to be 100%, that we'll definitely see a very nice little move up, right? Sometimes we see a tiny reaction and the market just continue to downside, right? I mean, you guys would know there's no certainty, there's no guarantee in the market, but we're always talking about probability, okay? And 50 to 618 area is a high probability area that the market tends to be attracted to it, and it tends to have a reaction around that zone, okay? Now, I'll give you another example that's coming down. So this is impulsive to the downside, okay? So we have a sense of momentum. If you can get a correction, we'll be interested in the sell trade, okay? And of course, what we have is we need to wait for three-wave pullback, the timing, okay? And then right now with FIPS, we have a rough area that we can look into, okay? Since this is coming down impulsive, so we're gonna pull from swing high to swing low, okay? And from there, we have a FIPS, 15 and 618. That's the area we're gonna be interested in, okay? Now, I just want to keep reminding you guys, it's not about just selling at a 15 and 618, right? It's about adding layers to your analysis, right? To kind of stack up the probability for yourself. So the idea is you don't want to just sell it when the market is here, but you want to remember, how do we want price to go up? If this is impulse, we want to see a correction move combination, right? That's what we call in the first lesson. So we want the market to actually retrace slower. It shouldn't be too fast, okay? So that we can get an impulse correction, which gives us a high probability of a downside. We also want to see a combination of a three-wave move, right? 1, 2, 3. So it should go slow. So when we have a slow corrective move, we have a three-wave move, and the market comes back towards the 15 and 618. That's where we have like alignment, right? Three things coming together. Perfect. It increases the odds and the probability that there's a very high chance the market will continue to downside, right? And that's where we're going to focus and look for sell. And follow the thought process, right? So this is where, again, you get an example, right? Again, you can see internally we have 1, 2, 3. Okay, and then we can't get a reaction there, a nice little move down. Okay, so these are examples. Let me very quickly also jump onto the charts to illustrate, to you guys some of these principles that we're talking about. Okay, now I'll use back very quickly on the Aussie dollar first. Okay, because this is already here. We have a very nice little case study that we can work on. Okay, let me just shift this a little bit back. Now, so this one here, obviously we can see, you know, this relative to this, what we have is this is faster. Okay, why? The price movement is big. Okay, I would say relatively bigger than what we have here. The time, okay, the time it took is relatively smaller. I would say half of what it took to develop. So naturally, this is impulse, this is correction. Great, we have a sense of direction. Okay, do we have a three-wave move internally? The answer is yes, very obvious, right? Very nice little 1, 2, 3. Now, where did the price came back towards in terms of retracement? Take from swing high to swing low, right? Why? Because that's the direction of the impulse. Look how nice the market is reacting off that now. Now, I'm not saying that it needs to 100% drop. It can maybe go higher from there, but you can see the reaction point. We have various component and elements coming together. The odds of Aussie dollar going lower is definitely higher than it going up. Okay, so I mean, when I talk about odds and probability, we can say, you know, about 60 to 70% of the time this would drop. Now, a good 30% it may not. But again, you're not looking for certainty, you're looking for just higher probability, right? So that's where, again, classic example. Okay, look at this here. Okay, I mean, this has already developed. Okay, by just bringing up some examples so that you can see different direction, you know, just see variations of it. Now, before this entire move, okay, we kind of saw this as a momentum move to the upside, right? Okay, so you can see the candle body is huge. And then as this develops, it's slower relative to the impulse. Do we have three wave internally? 1, 2, 3. Whether the market pulls back, swing low, swing high, 5618. Okay, I mean, if you are more precise onto that, it's here, same thing, 5618. And we have a combination impulse correction with the time element, three wave, with the price zone, 5618. Very nice little reaction to the upside. Can follow that, right? Now, just to also illustrate, not all the time is perfect. Okay, so let's talk about this one here. Oops. Now again, this has already developed, but I just want to show you, you know, this here is a fast move up. Okay, now this is not ideal, right? This is definitely not a corrective move. This is fast, this is impulsive. Okay, but I just want to show you in terms of Phipps, sometimes you get this, right? I mean, this is a pretty nice little bounce off the 618, right? It went a little bit deeper beyond the 50, but somewhere around 618, we get a nice bounce. Now, things like that, we will not be able to trade it. I mean, for me personally, I won't be catching this buy simply because this is very, very impulsive to the downside, right? Now, but some traders will say, you know, just buy the 50 and 618. Okay. Now, situation like that, obviously you will make money from buying that 618 to the upside. But sometimes what we experience is because of this momentum to the downside being very strong, you know, you may caught in an unnecessary trade where this continue to drop further. Okay, now obviously this is in hindsight, things looks great. Okay, but I just want you to know, you don't want to just buy it up or sell, or I would say you don't want to just enter a trade whenever you see a 50 and 618 pullback. Okay, because often when we talk about fits, you know, people tend to just forget or ignore the foundation that we've covered so far, and then they just jump into the thing that is, you know, on top of their head, because this principle, this content is the freshest. We just talk about it and then they just immediately open the chart, take their fit tools, measure 50 and 618, and then just trade it off, right? So I just want to re-emphasize and remind everyone, you don't just apply the fits like just by itself, okay? It's a complementary tool, you add on to it, okay? But you still need other analysis element to back it up. So far so good, yeah? So I hope that's clear. Okay, and I hope, you know, just by giving you a few examples, you can see how it's being implemented and being applied. And of course, you definitely also want to take this and after today's session, just practice it on a chart, right? You'll be able to see often. Okay, again, not all the time you're going to see success, but often, okay, more than enough, you actually see how price actually likes to react according to what we have mentioned, okay. Good. So the fifth expectation here, when we apply in the principal Elliott wave, is we always expect the market to pull back or retrace towards the 50 and 618. Okay, of course, you add on with a corrective development, you add on with a three-wave move expectation, then it's, you know, increasing the odds by a lot. Okay, so the idea here is we use this expectation to guide us in not only a entry potential, but we can also use the 50 and 618 pullback, okay, as a potential shorter term target, right? So some of you may be playing around with multi-time frame. Okay, so maybe you did your higher time frame analysis on the daily, but you don't trade off the daily time frame, right? You might be trading on the hourly. So if on the daily time frame you've done your analysis and you're expecting a pullback right now on the daily towards the 50 and 618, then naturally on the lower time frame you'll be trading the pullback, right? You'll be trading the pullback, and your target would naturally be the 50 and 618 retracement on the daily scale. Okay, so you actually can use the 50 and 618 as a potential entry area. You can also use this as a potential target zone, right? Depending on the strategy and the trade plan that you also want to use. Okay, now most often we use this unless, again, on very specific condition where we are looking at a wave 4 correction in a 5-wave structure. Okay, now we won't be touching on this because in terms of the market, especially in the FX currency world, I would say a good 80% of times we observe the simple 3-wave expectation, which is the 50 and 618, right? We don't really have a lot of impulsive 5-wave structure in the currency world. Okay, but of course, if you are looking at a clear 5-wave structure, then wave 4 would not come back as deep towards the 50 and 618, right? We use another Fed ratios, which is around the 236 and 382. Okay, but I don't want to, you know, add on too many things and then it becomes over complex and complicated, and then end up you being confused. So today's focus is very much on a simple 3-wave, and most of the time, right, that's what's going to happen. So we focus on the 50 and 618, right? So again, more examples on, you know, some of this illustration charts over here. You can see impulsive move, 1, 2, 3, come back to 50. Very nice little reaction. The market actually pushed back off. Okay, so over here, you know, very quickly again to recap, okay, creative expectation is complete. We would expect a deeper pullback. Okay, now what I mean by this principle, right, is the market operates in the fractal nature. Okay, so let me just jump back to the chart to illustrate on some of this principle. Okay, now since we're on this chart, we'll work on it here, right? So you can see this, right? This is a 1, 2, 3. Okay, now this is a 3-wave move that is completed. Okay, so the second session, right? The last session we talked about tree of expectation and how the market tends to develop in trees. So a 3-wave move is a complete set. Okay, often means that it's done. It's likely gonna do a retracement, right? And that's what we're gonna expect. Okay, so how do we know what is a potential target that we can look at for this retracement to happen? That's where we can also use back the Fib. But instead of pulling from this low to this high, we'll take it as this is a complete set, 3-wave inside it. That's one move itself as a bigger fractal. Okay, so what we do is we take from swing low to swing high, right? We basically measure the entire 3-wave completion. And often the market will then do a pullback again in sets of 3, potentially towards that 50 and 618. Okay, so that's what this means here, right? Often the 3-wave expectation is completed. We expect a deeper pullback towards the 50 and 618, which means 1, 2, 3, done. We take from swing low all the way to swing high, looking at this as one set, and then we expect a pullback to 50 and 618. And we again expect it to develop in 1, 2, 3. And follow so far here. Now, let me just very quickly find some other examples over here. That's one. Okay, so I think we just remove It is also up move, right? So the idea here, you can see 1, 2, 3, done. Okay. So often what we do is we take from swing low to swing high in the direction of that 3 sets, and we expect this may come back towards the 50 and 620. Now, not all the time, but that's the expectation that we can develop. Okay. Let me find a down move example if I can. Okay, we probably don't have a down move example for now. Yeah. Okay, but I hope you get the point, right? Let me zoom out a little bit to see this. Yeah, this is an uptrend, so we don't really have the example. Okay, but I hope you get the idea of it. Okay. Later, if you have time, I'll look at some of the analysis to share with you, and then see if we can discover any things that we can talk about. Okay. So good. So that's the Fib expectation. Okay, so again, this can be applied in the corrective move as we've discussed at the start, right? To look for a trend continuation setup. And you can also be applied in a three-wave impulsive move, right? Which is basically just now what we just covered. You see a three-wave completed, it's a complete set, you expect the retracement, okay? So this Fib area here is very flexible because, as I mentioned, it's a tool, okay? It's up to you as a trader to decide, do you want to be more of a trend following trader, or are you looking at also a counter trend, right? A counter trend means that we get a complete tree set, a complete three-wave move, and you are looking to trade the retracement, right? Playing around with the concept of different time frame. Okay, so depending on what style you're using it on, okay, the 50 and 618 Fib retracement expectation can be utilized. Okay, now this is again in the PowerPoint, but I illustrated this just now, right, on the chart, right? So you get to see 1, 2, 3, okay, completed. So we can take from swing low all the way to the swing high because this is one set, okay, and we expect the pullback to come back to its 50 and 618, okay, and I can see this is very nicely done, right? Again, internally 1, 2, 3. So again, that's usually how the market develops. That's the nature of how price tends to move, okay, most of the time. And as traders, again, you just want to capitalize and leverage on all this phenomenon that tends to repeat itself over and over again. Okay, good. Now that's retracement. Okay, now for me in Elliott wave, we use a lot of expansion as well, right? So for Fib expansion is a little bit different in terms of how we utilize and how we pull it. Okay, so Fib expansion is often used to forecast, right, the distance that price can potentially move into in relation to a recent retracement. Now that may sound very, very complex, but let me just show you some examples, okay? But quickly, we often use, again, 80 to 90% of the time, we use this 100% in 1, 2, 3 area, okay? So what is the 100%? Later in a while, I'll explain that to you, okay? Now, let me jump to the chart to illustrate this point for you guys, yeah? I'll utilize the Aussie dollar example. Okay. Now, what I mean by using it to, sorry, let me find maybe a clearer, okay, sorry, pound yen is good. Let me delete everything. Okay, so what I mean by we are using this tool to measure how far price can potentially move after a recent retracement. Okay, now take a look at this. This is a move down. Okay, and this here, we'll take it as a retracement. It doesn't really break that high. So this so far now is a retracement. We start to see a tiny bit of sign that this is coming down. So what we want to know right now is how far can it go? Okay, so from here, it does show sign that it's coming down. So how far can it go further? So now what we have established at this point in time is with this point, the starting point, the market came down. That's the second point. The market did a retracement, and the retracement seems to have completed as the market is coming down now, continuing to the downside, and this is our third point. Now, to utilize this tool, you need a minimum of 3 points, right? Your starting point, the end of the first impulse move, and then the end of the retracement move. Now, the tool here at MT5 is this, right? Expansion. You need to click one time at the starting point, click and hold the second time, and then drag it all the way to the third point. Okay, now just put in the Fib here at 100%. Okay, now what does 100% means? Is basically measuring an equal move. Okay, now, so what is an equal move? Is basically taking the measurement of this initial move, okay, and then duplicate this length to where the retracement has ended, right? So you can see kind of equal length, right? So 100% is basically the equal move of this. Okay. Now, this is sometimes called a harmonic move as well because it's nicely 1:1. Okay. Now, most of the time, that's what the market is likely going to have in terms of reaction. This zone. Now, how or why do we use this? Is because you look at this chart, right? Why I picked this chart example is because we have an impulsive move. What the market is developing here. The market is developing correctively as of now. In relation to what? In relation to this impulse move. Okay. So we get a sense of direction, right? Our sense of direction is we are interested in a bullish bias. We're interested in buy, right? So we get a sense of direction. Done. Timing. Okay. Is it time to buy now? We have our first move down, second move up. The third move is developing maybe soon. Okay, because we want to see the three-wave move. Where would this likely end? Okay, so just now we talked about retracement. Obviously, we can take from this low to this high. 50 and 618 is there. Okay, which basically testing it right now. Now the other Fib we can use is basically the expansion. Okay, now I like the expansion if things are a little bit clearer when we can see 1, 2, and when the third one is developing. I like to use the expansion because the expansion complement the principle of a channel very nicely. Okay, a parallel channel. 1, 2, 3. Often the 100% will come and coincides with the bottom of this channel right now. Okay, so what we are expecting here is for the market to come down a little bit more. I'm not too keen in selling this if I'm looking at the swing trade, but I'm more interested is after the market completes this, I may get a buy opportunity here. Okay, so what I'm using this Fib expansion is to look out for areas for potential entry. Now, can I use it for target? Yes, I can actually go down to a lower time frame and say that, okay, if I'm expecting the market to go down a little bit more to complete a bigger structure, then on the lower time frame, if I can get a corrective pullback here, again, I can utilize principal impulse correction, 5618 pullback. I can look for an intraday short-term sell, and then where's my target? I'm going to use the higher time frame as my target. Okay. So again, I want you to see the flexibility of retracement tool and expansion. You can use it for areas of entry, you can use it for areas of target. But the most important thing is you need to first understand the principle behind it, the function of it, okay, and how you're going to use it really determine on your trading style. Are you short term? Are you swing trade? Are you interested in looking at multiple time frames, to give you a bigger picture and more holistic understanding of like, okay, if the higher time frame is likely going to go there on the shorter time frame, I can then use that as a target. Okay, and then when it hits the target on the higher time frame, then I would switch my directional bias and look for a new entry point and things like that. Okay, so it becomes I would say a very comprehensive tool for Fibs, okay, to really guide you in achieving the objective of precision target areas, right, or precision price area. Okay, and at the very start of today's session, we can't cover, right, each component has its function, has its objective, right? When we look at impulse correction, we look at pattern combination, what's the end goal that we're trying to get out of that direction? When we look at wave expectation, whether is it 3-wave or 5-wave, what is the end goal, what's the objective that we try to achieve from there? time expectation, right? We want to roughly understand time, okay? And FIPS, as we are covered today, what we're trying to get out of it is which area in price are we going to be more interested in? Okay, so each of this starts to give you a very clear function in your strategy, in your analysis process. Okay, so hope so far so good. Okay, so things like, you know, Aussie dollar, for example, right? If you look at retracement, we can't get that 56.18. If you look at a expansion, we also can't get a very nice little 100%. Okay, if I were to add in the 127, okay, that's the area, right? So again, often you don't want to over complex your chart, right? So you don't pull FIB retracement, you don't pull expansion, you know, all over the place. You choose one, right? Most of the time they come quite close, right? So for me, I would say personally I use more expansion, which is the 101.27, compared to retracement. Okay, so we kind of very nice impulse correction, three wave. We have the FIB areas here as well. Where would we look for targets? Okay, now what we can do, of course, we can also use this, okay, to look for where would that target be, right? So equal leg, that will end up somewhere there. Okay. Now, of course, you don't want to just blindly use it. In a way, it comes with some experience over here. Now, for me, Aussie dollar, would I put a target down there? Probably not so low. Okay, why? Because this has came down quite a bit. So that comes with a little bit of experience, right? A little bit more advanced understanding of wave as well. My target wouldn't be all the way down there, to be honest. Why? Because again, this has come down quite a bit. I'll be looking primarily at something like a fifth wave. Whoops, okay, I clicked the wrong aspect, right? 1, 2, 3, 4, 5. Because I'm looking at a fifth wave development, I don't expect this to keep going all the way, right? Price has came down quite significantly. There's a good chance we may start to see a little bit of a deeper pullback, okay? So my target on this, I'll still use FIBs, okay? Because why? The function and the role of FIB is to really give us that precision point, okay? But I'll use it slightly different. I'll actually use this to look for just a very simple one. Sorry, let me edit this. Okay, this is what we call extension. Okay, there, right? So I wouldn't be overly aggressive by looking at too far the targets, right? Now, what is that? What is an extension? Okay, you see the area. Sorry, you see the area here is 127, right? And just now you saw me pull. I'm basically pulling from here to here. So what I'm measuring, right, is this length, I would say that price magnitude, okay, and 127, meaning from here, this peak to this price point, that is a 30% more compared to that initial move here, right? So this one, okay, if let's say this is 100%, this 100 units, then this one here is 127, right? So you can see an extension of 27%, right? So that's basically the math behind it, right? The understanding behind it. Okay, so often wave 5, one way to measure where would it likely end is using the 127 extension. Okay, but again, you don't often see this a lot. Okay, so I just don't want to be like putting in too many information in one session. Okay, I just want you to be focused, at least be very familiar with some of those most common ones, right? Because this one is not very frequent. Okay. More examples. So things like this, right? Like let's say if you open up crude oil, and then now you see that, you know, from last Friday we get a very impulsive move to the upside, right? We get a sense of direction because if you can get a corrective pullback here, we have the upside, okay? Because impulse correction upside. Now, of course, you know, if we get an impulsive move down or a strong rejection, we won't be buying it. We won't be bullish bias. We'll wait. Okay, that's what we cover in the first lesson, right? So given that we know what we want a correction, okay? We also know what we want. We want this correction to ideally develop in three wave. It shouldn't come back too fast. It should take time. Be patient with it. It should ideally be a three wave move. We can then also use some Phillips, swing low to swing high. Okay, and of course, I'll just put the 50 here, right? Just to be quick. Okay, but of course, you know it's 50 and 618, yeah? So we expect the pullback to come back somewhere there, right? Of course, when it starts to develop 1, 2, and starting to show sign of 3, what can you do? Okay, you can start to use expansion as well, right? Something like that, right? Most of the time, it comes quite close. Okay, and of course, this then becomes the area that you'll be looking to buy. Okay, now S&P, give you another example of that. Okay, now what we have over here, just now we kind of built in a little bit already, right? So on the 4-hour chart, what do we have in our S&P? We have a completed three-wave move. Okay, so after a three-wave move, what do we expect? We expect a deeper pullback, 50 to 618. Okay, now what does this mean? Of course, if you're a swing trader, you'll be patient, wait for the pullback, and then look to buy there. But if today you're more of a shorter term trader, looking at a high time frame give you the perspective and tell you that, okay, if I'm expecting this to come down, you'll be thinking, can I look for sell here? Is it worth it? Now, just based on this, what's the objective and function of this is to give you a perspective of, is the trade in terms of risk to reward potentially worth it, right? So if you look at where we are right now, potentially your risk will be there, your potential target is down there. Look at this, okay, makes sense, right? I may want to consider on a shorter term because if I can sell and my target is there, my risk is up there, then the risk reward makes sense for me to consider it, right? Of course, if the market has already came down all the way here and then, look at risk reward, maybe it's not worthwhile. Okay, so again, what's the function of all this? You need to understand, like, what's the purpose of us doing things like this? Okay, so this gives me a perspective where there might be a good potential profit that I can capitalize on the smaller scale. Okay, so of course I don't just blindly sell it, right? I also use back the principle. What pattern do we have? Okay, do we have different elements stacking up in our favor, right? So if I start to go down on hourly, can you see this is the crawl pattern that we kind of used the example just now, right? So what's a crawl pattern? A crawl pattern is a reversal pattern. So we have like higher time frame, three wave completed, we're expecting a deeper pullback. On a lower time frame, we have a reversal pattern also telling us a potential pullback or to the downside. Great. Then of course we don't just sell also, because what we want to see here, if I zoom in, okay, what we want to see is, can we get on the smaller scale, same principle applies. Can we get an impulse correction, right? So kind of got an impulsive move right now. Market seems to be developing a correction. It needs a little bit more time. Why? Because principle of three. We have 1. This will likely maybe come back a little bit. This will probably bounce up a little bit. We can use our Phillips to guide us in terms of, okay, where would this correction likely come? Okay, again, I only have 50 here, but usually we'll look at 50 plus the 618, right? Let me remove that. Okay. So that will be the area, right? Roughly estimated. So again, on hourly, what does this mean? This is on S&P, it's not a 24 hours market. So likely maybe by tonight or even tomorrow, this may happen, right? Of course, if that happens in a corrective manner, it needs to be slow. Okay, we need to give us three wave move. The area that we're going to focus is there. Then on the short term, that becomes our opportunity to sell. Where would the target be? Of course, we can look at a 50% on a high time frame as a potential target. Okay, so again, you can see, right? If I'm a swing trade, I'll probably not be too keen in selling this. If I'm a short-term trader, I can look to trade the retracement on a higher time frame. But the principle, you can see what we've applied is the same. It doesn't matter which time frame you're looking at. You need to find your direction. You need to have a time element. You need to have an area of precision that you're interested to execute and jump onto trade. You need to have some targets in mind, right? So again, this is what we have covered so far in the 3 lessons, right? The first is direction, the second is timing, and then the third one here is precision area, okay, price areas, okay, helping us to identify entry zones as well as target points. Okay, so I hope so far so good. I think that's, I did not use the slide to cover, okay, but I directly jump on the chart. I hope that's fine, right? Yeah. Hope that's also clearer. Okay, good. So we do have a couple of more minutes. Let me take some question. Then after that, I'll need to pass the time back to Yijie, okay, to do a quick closing for today's session here as well. Now, good. I see some question coming in. Okay, so I think Gary's question has been answered. So Lee has a question here. Usually you use the fit in which time frame? I think Gary also asked like what time frame is the chart? Yeah, so for me, right, I primarily look at H4 and H1 charts. Okay, so again, just now we can cover the principle can be applied on any time frame. Okay, of course, the lower the time frame you go, you need to be a little bit more sensitive to the trading session, like Asia, London, US. But the principle is the same, right? You can be applying this on any scale. Just need to be aware of, as I mentioned, the sensitivity of like different trading session if you go to a lower time frame, right? But if you're doing it on like hourly on a 4-hour, the time frame perspective has already factored those trading sessions in. Okay, so you don't need to worry too much about it. But if you drop down to like 15-minute, 5-minute, definitely you need to add in, the sensitivity of the trading session. Like Asia is usually on a 5-minute is range, right? Because it doesn't move a lot. Okay. In US, in the London market, 5-minute can be impulsive in nature, okay, because that's where volatility kicks in. All right. Okay. Pang here asks, is it possible to have a list of links of the webinar for easier tracking and rewatching? I may not have it, okay, but again, you might be able to maybe reach out to Phillip Nova support and see if, I think the YouTube is quite easy, just, compile that previous 2 session and then today's session. Okay, yeah. Okay, so Ben question over here, what's the best time to trade major currencies? If you are looking at currency market, usually in like Singapore, Malaysia time zone, the UK market opens around 3-4 p.m., right, depending on daylight saving. Usually that's where the volatility kicks in. Usually that's where market would start to move. Okay, so obviously if you're doing intraday, the UK to the US session is the prime time, right, to catch trade. But if you're more of a swing trader, you don't need to be too hop out onto like, oh, I need to be in front of my computer, I need to be in front of my desk, during the London and the US, because a lot of times when you're doing swing trade, you're using pending orders to execute it, right? Basically set it, whether it's a breakout or wait for price to retrace and then you just put in a pending order. If it hits it, it automatically fills the order for you. So then you don't need to be overly worried like what time, okay? Because most of the time, again, depending on lifestyle, right? You may be able to perform the analysis, put in your order in the morning, okay, and then you basically don't need to be always monitoring it as a swing trade. And then when the market opens, when volatility kicks in, maybe you just monitor, right? Oh, okay, if the trade is triggered, do I want to manage it and things like that, right? That's about it, right? Or maybe in the morning, if you're busy, then you may look at the market in the evening, in the night, to set it up for maybe tomorrow's market condition, right? Yeah, so that's again, what is the best time to trade really depends again on your style, okay? Whether you're a swing trade, it's a little bit more relaxed way. If you're more of an intraday, of course, you need to spend a bit more time in front of your desk. Okay. Yeah, good. So I hope today's session give you a deeper understanding of the processes and the steps to actually apply Elliott wave on the more practical aspect. Okay, instead of like a lot of times people talk about the 1, 2, 3, 4, 5 ABC kind of label. That is not like the most practical aspect of Elliott wave. Okay, those are important principle. Okay, but I think the more practical aspect is what we've covered so far in this 3 session, and hopefully that gives you some ideas to work on, right? Some insights to work on. Okay, good. So with that, I'll quickly pass the time back to Yijie to do the closing. Okay, and also to let you know, like the last session that we're gonna have in the future would wrap up everything itself. Okay, yeah. So I'll pass the time back to you.
Great, thanks Kar Yong for the session. Informative as always, and really want to drive home the point that you mentioned. No, it's not just about the labeling on the charts. Many people trip up in the aspect, but I think what you've taught is really the concepts and the underlying fundamentals of Elliott Wave, and I hope that that has been beneficial for those of you attending. So for those of you attending, thank you for your attention and time to be here with us to attend this session. So great news for those of you who have enjoyed this session today. Many more to come. So this is not just a once-off partnership. Of course, we have a weekly market analysis, right? So if you would like to see the session that Kar Yong mentioned earlier being put into action, how do you identify market opportunities over currencies, indices, and perhaps equities? So we do this on a weekly basis where Kar Yong removes the theory, right, and jumps straight into the charts and identify with you on a week-to-week basis. Number one, what are some economic data that will impact the market? Number two, what are some opportunities based on Elliott Wave theory that we can identify? Right, and of course, in these sessions, if you are an attendee, we do send you the recording, we do send you the report as well. So how can you participate in these sessions, right? So these are done currently exclusively for clients. So for all clients of Phillip Nova, they have free access to these sessions. So the benefits of the weekly session is that you really do get a recap of what has happened, what is upcoming, and perhaps a refresh on the opportunities that were covered. So if you want to participate and you're not a client yet, do open an account, and I will share with you in time to come what are some of the perks, right, of being a client. So once you do that, if you're a client, you should receive on a weekly basis in your MT5 mailbox and push notification for a registration link, right? So sign up early to reserve your slot. So the next part that Kar Yong mentioned on the fourth parter, right, that will be taking place on the 2nd of October. So where he will wrap up the sessions that he has been sharing. So on the week-to-week basis, what can you expect, right? As I earlier mentioned, you can expect actionable trading opportunities, the same kind of forum in which you can engage with Kar Yong, asking questions about markets, risk management, sentiments, and so on and so forth. Stay up to date with the latest development on our platform, Phillip MetaTrader 5, and some very exclusive giveaways and promotions that we only give our attendees. Right, so earlier I mentioned about the recording and report. You can see a sample of them below. So this is in essence what you will receive from us. So there is also an exclusive giveaway of a FX trading e-course, right? This is curated by Kar Yong himself. He covers many key modules that are very pivotal to traders, whether or not you are a beginner or you are a experienced trader in the market. This will serve as a good recap or introduction to trading. It covers modules like fundamental analysis, technical analysis, risk management, trading psychology, and more. So this is a limited time giveaway. Usually we do this in our weekly session. There are some criteria you have to fulfill. So of course, those sessions being only eligible for clients. Again, you need to be a client to access these sessions to learn more about how you can be eligible for this. So on to the reasons of why you want to become a client. Right now, we are celebrating our 40th anniversary. Right, Phillip Nova has been established since 1983, previously known as Phillip Futures. I apologize for a slight skipping a bit, but basically, we are giving away a Lumos projector, right? A Lumos home cinema in the month of September. All you need to do is to open an account under 40th, under a special link. Once you scan the QR code, you should see it. And indicate 40th anniversary under the section, how do you know about PNPL? Fund your account with a minimum of $4,000. Now, there's no trading requirement, right, in order to receive this. But of course, this is limited to the first 40. So for existing clients, good news also, there's something for you, right? We are holding a lucky draw on a 2-month basis. So these are the prizes that you can stand to win. 40 lucky winners. In this season, we can have the Apple iPhone 14, flight gift card worth $800, a Dyson V10 vacuum cleaner, and $40 in trading credits for the 4th to 40th. So scan the QR code to find out more. This is how you can be eligible for it. You place a live trade, a live Forex trade. Again, I apologize for the skipping slides, some technical issues there. So you place a FX trade of any size, and from August to September, you get a chance. You trade via Equity Signal Center plugin. That is a module we have on MetaTrader 5. And then or you trade via Nova 2.0, our other application, and you will get a chance, right? So each entitled to a maximum of 3 chances. Scan the QR code to find out more. So if you have any questions at all about today, we always encourage our attendees to interact with us through the questions and answer. So if you have some which you think about at the end of the session, there's 2 ways you can do so. After this session, we'll send you a feedback form in which you can include additional questions you have not managed to ask in this session. You can include your feedback of the session, what you felt went well, what could be done better, and we would love to hear them for you. So for longer form questions which require a bit more explanation, right, you can reach out to me directly. My name is Yijie on behalf of the team of Phillip Nova. So that is my email address. You can write to me directly. So once again, I want to thank you all for your time for attending this lunchtime webinar with us. I hope that it has been extremely beneficial, and I look forward to see you next week. Thank you, and goodbye. Have a great rest of the week ahead.